To conclude our discussion of the accounting cycle, we need to discuss internal controls. Controls are the methods used by a company to safeguard its assets and provide reasonable assurance of the accuracy of the accounting data. In a sense, internal controls are like ninjas. They operate behind the scenes, and you never see them when they're functioning. They protect bad things from happening to your company, namely fraud. There are three categories of internal controls that we need to be aware of: our operational controls, our reporting controls, and our compliance controls. The first group of controls, the operational controls, address the protection of assets. And you can remember that with the moniker, do not steal. The second category of controls relate to the reporting of financial information. Do not lie. The third set of internal controls relate to compliance with laws and regulations, especially those related to the preparation of the financial statements. A way to remember the compliance controls is do not cheat. We've discussed the accounting cycle and run through it with two businesses. Accounting controls operate within the accounting cycle, and there are four broad categories of accounting controls that help fulfill the three control objectives: do not cheat, do not lie, do not steal. These include documentation requirements, or making sure that each transaction is supported with an audit trail. Authorization requirements, which is making sure that all transactions are properly approved before being entered into the system. Protected physical assets, so preventing assets from being stolen, including cash assets. And finally, independent checks, making sure that someone outside the process is looking over the process. Let's talk about these in a little bit more depth. In discussing the different phases of the accounting cycle, we've alluded to the various source documents that are used to establish that a transaction has occurred. These are an important control. They include documents like invoices, purchase orders, requisition orders, receiving reports, shipping reports, canceled checks, bank statements, and the like that form the audit trail and help improve the likelihood that the correct information is transmitted to the correct users. Examples of controls related to documentation include sequentially numbered documents. This allows auditors and accountants to determine whether all documents are accounted for. A missing document could be indicative of fraud. They allow for 2- and 3-way matching. The more times you can correlate a transaction across different forms and different signatures and different time periods, the more you can trust the transaction. And finally, duplicate or carbon documents that can be used for multiple purposes. Another group of controls is authorization controls. In discussing the various phases of the accounting cycle, we discussed how to record transactions, but these transactions must be authorized. For a transaction to be authorized, it must indicate that it has been approved. This can be either through a written signature on a document or a system stamp of approval or control. When we get into our discussion of electronic accounting systems, we'll talk about levels of access and authorization. Sometimes approvals can be built into the system, as with credit approvals for orders made on account. Another category of controls is independent checks on performance. An example of this that we performed in our discussion of the transaction cycle is the preparation of the trial balance. These independent checks answer the questions: is the accounting accurate? Is the accounting complete? Meaning, have all transactions been entered? And is the preparation a faithful representation of what happened? Can you rely on it? Examples of independent checks include recalculations, reconciliations, sequencing, or making sure that all checks, all invoices, anything that has a number appear in order, and comparisons. Independent checks are important when the adjusting entries are made within the accounting system. Someone at a high level in the organization should review and approve these transactions before they become permanent. Another grouping of controls related to adjusting journal entries is the control related to segregation of duties. With segregation of duties, you're making sure that only certain persons can perform certain tasks within the accounting system. That is, if any one person in the organization performs more than one character arc, is the way you can remember that, your organization is susceptible to fraud. ARC is a mnemonic device, meaning approval, record keeping, and custody. We've discussed what it means to independently review documents and what it means to grant approval to a transaction. Record keeping refers to the tasks that we've been working through, entering the transactions into the ledgers and the general journals. Custody means protecting and holding on to the assets, as inventory custodians do, as the persons in charge of grouping shipments to be sent to the customers do, as people with access to the checks do. Let's look at a real life example related to the controls we've discussed. This comes from my prior career as a government auditor. The Department of Energy maintains a program called the Weatherization Assistance Program. Through this program, they allocate a set amount of funds to each state. Here in my former state, the state of Maryland, and the state organizations allocate funds amongst the different counties and communities within their states. These funds are to be used to make homes more weather efficient. When a home is more weather efficient, it costs less to heat and cool the home, saving the occupants money that they might not otherwise have. One of the elements of weatherization is replacing up to 10 low energy efficiency light bulbs with the more expensive high efficiency compact fluorescent light bulbs. As an example of an independent check, one of the categories of internal controls we've discussed, the Department of Energy Office of Inspector General audited the state of Maryland's use of weatherization funds and specifically examined how the city of Baltimore was carrying out the grant. When we investigated the records and performed other physical inspections, we realized that the city of Baltimore had found a way to purchase compact fluorescent bulbs at a bulk rate of $1 per bulb. When they went to seek reimbursement from the federal government, they charged the federal government the maximum allowable reimbursement rates, which was $10 per bulb. This audit was conducted more than 10 years ago. We also conducted a physical inventory comparing the inventory records on paper and the number of bulbs that were in the warehouse. Even after taking into consideration the number of bulbs that were on the trucks to be installed for that week's jobs, we found significantly fewer light bulbs on hand than reflected in the records. This implied that employees were bringing bulbs home with them for their own purposes. All told, this resulted in the city of Baltimore overbilling the United States federal government to the tune of $43,500. The issue? What went wrong? The control that failed was a lack of segregation of duties. When we looked into the root cause, we found that the same person who authorized the purchase of bulbs, which is an authorization activity, also prepared the invoices for the federal government. They were able to conceal the fact that they bought the bulbs for much lower than they sought reimbursement from the government. We also found that the same person who kept inventory of the bulbs at the warehouse was in charge of maintaining the inventory records, so the record-keeping function. This allowed for bulbs to be overbilled, as well as bulbs to be stolen from the government. We used our knowledge of internal controls to detect this fraud. We reviewed the document trail that the city of Baltimore had maintained, and we used our audit ninja skills, testing the internal controls and performing these independent reviews. The example with the city of Baltimore emphasizes one important category of independent checks, those performed by the independent financial statement auditor. Accounting has a significant amount of judgment to it, and many of these judgments are performed by the organization's top levels of management, particularly the chief financial officer. The board of directors in a publicly traded company hires and oversees the CEO and the CFO's actions, but in private companies or smaller companies, they might not have the same oversight, which means their judgments surrounding whether or not to capitalize costs and hold as assets on the balance sheet, or whether to expense them immediately, how much of the assets were used during the preceding period, as well as accruing for income that was earned during the period but not yet received, are made by management. Once the financial statements have been prepared, the audit is the final independent check that the financial statements are prepared in accordance with generally accepted accounting principles, that the values in those financial statements are generally free from material misstatements, and that you can rely on the statements made by topmost management.